Is the US recession imminent? When examined over long periods, Wall Street three major stock indexes, the widely followed Dow Jones Industrial Average, growth-based S&P 500, and growth-dependent Nasdaq Composite, have risen in value without fail. But it's a far different story when the lens has narrowed to mere month or perhaps a few years. The Dow Jones, S&P 500, and Nasdaq Composite, just like the US economy, can be completely unpredictable over shorter timeline. In fact, all three stocks indexes have traded off bear and bull markets in successive years since this decade began. Now, truth be told, there is no perfect forecasting tool or ideal blueprint that's going to, with 100% accuracy, tell investors or economists what stocks or the US economy will do next. Nevertheless, there are a couple of predictive tools and money-based metrics that have, over extended timelines, correlated strongly with moves in the stock market and or US economy. One of these indicators, which happens to be a leading tool from the Federal Reserve Bank of New York, has an uncanny track record of forecasting downturns in the US economy. So is a recession imminent in the US? Well, at the moment, the US economy is humming along nicely. US gross domestic product is growing on an annualized basis, and the labor market appears healthy, with the unemployment rate clocking in at a low 3.7% for January. But all may not be what it seems, actually. Every month for the past 65 years, the Federal Reserve Bank of New York's recession probability tool has utilized the spread difference in yield between the 10-year Treasury bond and 3-month Treasury bill to determine how likely it is that a recession would take shape over the next 12 months. Now, normally the Treasury yield curve slopes up and to the right. This is to say that bonds set to mature in 10 or 30 years should have higher yields than Treasury bills maturing in 1 or less. The longer your money is tied up in interest-bearing securities, the higher the yield should be. But every now and then, when investors are clearly concerned about the near-term outlook for the US economy, the yield curve inverts. Just as its name implies, this is when short-term bills sport higher yields than long-term bonds. The greater the yield curve inversion, typically the higher the probability of recession taking shape. Let us make one thing clear. A yield curve inversion doesn't guarantee a recession is imminent. There have been inversions where a recession didn't take shape. However, every recession that's occurred since World War II was preceded by a yield curve inversion. It's been a necessary ingredient to an economic downturn. Over the past year, we've witnessed the steepest yield curve inversion in roughly 4 decades. Not surprisingly, the Federal Reserve Bank of New York's recession probability tool believes there to be a 61.47% likelihood of a recession taking place by or before January 2025. Although this isn't a guarantee, nor is it the highest recession probability on record, it does mark one of the highest probabilities for a recession to take place since the early 1980s. The Fed's leading recession indicator doesn't have a perfect track record of forecasting downturn, but it's pretty darn close. Despite a recession probability of over 40% in October 1966, no economic downturn occurred. But since this incorrect procrastination in 1966, anytime this recession probability tool has surpassed a 32% likelihood of a downturn, one has taken place not long thereafter. With a reading of 61.47%, the writing would appear to be on the wall that a recession is very likely in 2024 based on this predictive indicator. Recessions can be especially meaningful for the Dow Jones, S&P 500, and Nasdaq Composite because these indexes have historically performed poorly after an official recession is declared by the National Bureau of Economic Research. Although the US economy and the stock market act independently of one another, corporate earnings often suffer when US economic activity is slow or shifts into reverse. If the New York Fed's recession tool proves accurate and a recession does take shape in 2024, a sizable pullback in equities isn't out of the question. Patience is a virtue and a moneymaker on Wall Street. Now, to be fair, the Fed's recession probability tool is just one around a half dozen indicators and economic data points have examined recently that suggests trouble may be brewing for stocks. Declining M2 money supply, tighter lending standards for banks, and historically high valuations are all examples of metrics with strong correlations to downturn in the stock market. However, patience and perspective can change everything when putting your money to work on Wall Street. To state the obvious, we're never going to know ahead of time precisely when stock market corrections and or bear market will begin, how long they will last even, or how steep this declines will ultimately be. But based on what the decades of history have shown us, we also know that recessions and stock market corrections are both short-lived events. In the 78 years since World War II came to a close, the US economy has navigated its way through 12 downturns. None of these contractions resolved themselves in less than a year. Out of the remaining 3, none surpassed 18 months. Comparatively, almost every period of expansions can be measured in multiple years. Put another way, the US economy spends a disproportionate amount of time expanding. It's a similar story on Wall Street, although the S&P 500 has endured 40 double-digit percentage corrections since the start of 1950, an average of one sizable downturn every 1.85 years. We've witnessed each and every one of these drops eventually get wiped away by a bull market. This disproportionate bullishness can also be seen in the average length of bear and bull market for the benchmark S&P 500. This past June, researchers at Bespoke Investment Group released the data said that examined the length of bear and bull market in the S&P 500 dating back to the start of the Great Recession in September 1929. While the average bear market has stuck around for only 286 calendar days, or about 9.5 months, the typical bull market since the late 1920s has endured for 1,011 calendar days, or about 2 years and 9 months. Though stock market corrections, bear market, and even crashes can be temporarily unpleasant, they're short-lived events that have ultimately been blessings in disguise for patient investors. So even if a recession is in the cards for 2024, there is no reason for long-term investors to worry.